All right, let's jump right into this explainer and systematically upgrade how you read institutional market structure. Today, we're taking you from a basic beginner's understanding of momentum all the way to a highly professional, systematic approach to trading. We are going to completely decode the concept of displacement.
But first, let's talk about the pain. We've all been there, right? You spot those clean, wide-bodied candles, you see a structure break, you meticulously map out the absolutely perfect fair value gap, you patiently wait for the price to pull back in, and then, boom! Price blasts straight through your level like it's not even there. If you've ever been caught in what's known as a liquidity trap displacement, you know exactly how frustrating it is to take the bait on what looked like an A-plus setup. You weren't just unlucky, you were trapped.
And honestly, that is the core difference in market mechanics. Beginners tend to just chase the sheer size of a candle. They assume big equals momentum and continuation. But professionals, they're reading the intent behind that repricing. They know that true displacement is an institutional message. Sometimes it's the honest truth, and sometimes, well, it's a very expensive lie. Your job isn't to just hunt for more big candles, it's to actually qualify the intent behind them. So here's our roadmap for this explainer. We'll start with the retail liquidity trap, then defining authentic market displacement, the institutional footprint, the displacement trading sequence, and finally, advanced execution and risk. Let's get started. Section 1. The retail liquidity trap. Why chasing big candles fails. You can think of institutional misdirection a lot like a fake pass in basketball. Retail traders are constantly watching the ball. They're just totally mesmerized by the fast-moving candle. But the institutions, they're watching the floor space. They're mapping out the liquidity zones. They know exactly where those stop losses are resting, and they are intentionally engineering price to hit those exact zones. Because the reality is, markets aren't random. They're delivered by algorithms, specifically what we call the Interbank Price Delivery Algorithm, or IPDA. This algorithm means price moves systematically. It shifts between quiet periods of range consolidation, where retail traders are busy placing their stops above and below, and rapid directional expansion. It specifically hunts those concentrated pools of retail liquidity to fill massive institutional orders, and only then does it aggressively expand in the true intended direction. Section 2. Defining authentic market displacement. Decoding the institutional algorithm. So to look at this quantitatively, we need to talk about Kyle's lambda. This is a crucial price impact coefficient. During a true displacement event, market makers realize that informed institutional money is completely dominating the order flow. So to protect themselves against adverse selection, they rapidly adjust prices in thin, illiquid conditions. This aggressive event makes Kyle's lambda absolutely spike. It's not just regular buying pressure, it's a forceful algorithmic repricing of the asset into a completely new value zone. You see, before that massive displacement even occurs, institutions are quietly doing the work. First, they use passive accumulation. They deploy hidden iceberg orders to absorb all that retail selling pressure without budging the price, keeping a high absorption ratio to completely hide their intent. But once that accumulation is wrapped up and their passive limits are exhausted, they instantly flip the switch to active execution. They just unleash aggressive market orders that forcefully displace the price, and boom, that's the explosive momentum you suddenly see printing on your chart. Now, when algorithmic systems actually score the strengths of these institutional moves, they aren't just guessing. They heavily weight the physical price expansion, meaning how far the price actually traveled from its origin point, at about 60%. But, and this is absolute key, that has to be verified by a massive spike in relative volume, which makes up the other 40%. You absolutely need both expansion and volume to confirm that real institutional capital is backing the move. Anything less? Yeah, it's probably a trap. Section 3. The institutional footprint. Separating signal from noise. Okay, these parameters are essentially your ultimate filter. True displacement is calculated, it clears major liquidity first. It prints these large bodies with minimal wicks, which screams one-sided control. It forces a clean break of market structure that actually holds, and crucially, it leaves behind a crystal clear fair value gap. Contrast that with pure news-driven volatility, which is messy, whipsaws everywhere, and any gaps it creates are usually ignored or just instantly filled. And this perfectly brings us to market memory, which is exactly why you literally never need to chase that initial surge. High-quality imbalances left behind by true displacement will act as major reaction zones weeks, sometimes even months later. Why? Because the institutional players who kicked off that aggressive move have massive layered positions anchored right there. They are going to actively defend their entry average if the price dares to return to that origin zone. Section 4. The displacement trading sequence. The 3 mandatory parameters. So we are looking for a highly specific 3-part sequence here. Step 1, the liquidity sweep. Price absolutely must attack obvious stop clusters first to gain fuel. Step 2, the price surge. That's the actual aggressive, wide-bodied algorithmic repricing. And step 3, the market structure shift. That surge has to break a valid prior swing point to confirm true directional intent. Let me be clear, if you do not have a sweep, a surge, and a shift, you don't have a trade. You just have a random candle on a screen. Once those 3 parameters are hit, that's when you look for the footprint, the fair value gap. This is a very specific 3-candle sequence. The rapid price movement leaves this unclosed space between the wicks of the first and third candles. That gap is the literal, physical footprint of the smart money stepping in with so much speed and purpose that the market didn't even have time to offer a balanced, 2-sided auction.
Section 5, Advanced Execution and Risk. The professional blueprint.
Let's walk through the actual life cycle of a trade. At minute 0, the liquidity sweep targets those retail stops. By minute 5, the aggressive institutional repricing is firing off. By minute 15, your market structure shift is confirmed. But notice the real secret here. The professional entry does not happen during that crazy fast-paced emotion at minute 5. The pro enters at minute 45, during the quiet, incredibly boring retracement right back into the fair value gap. To pull this off consistently, you've got to stick to a strict 5-step blueprint. First, anchor yourself to a higher time frame bias. Your daily or 4-hour charts dictate the actual trend. Second, qualify the lower time frame displacement using our sweep, surge, shift rule. Third, mark out the fair value gap. Fourth, just wait for the return. Patience is literally your edge here, especially during those high-volume London or New York kill zones. And fifth, trigger your entry with precision on the lower timeframes. Stick to this, and you align your capital with high-probability institutional flow, completely ditching retail hope. Now, for those of you running quantitative filters, here's the actual math. Systematically, quants are looking for an absolute candle body expansion that exceeds the average true range by a factor of 1.5 to 3.0. By normalizing that expansion against historical volatility, you mathematically confirm that the move isn't just standard market shop, it's true, undeniable institutional repricing anomaly. At the end of the day, true displacement is always going to reward patience over speed. It requires you to step back, recognize the liquidity engineering that's playing out, and simply wait for the market to come back to your level. So ask yourself, how are you going to react the next time the algorithm drops the rope? Are you going to be out there chasing the candle, or will you calmly wait and track the footprint? Thanks for joining me on this explainer. Keep your charts clean, respect the structure, and I'll catch